All right. Well, good morning and welcome, everyone. My name is Tom Vukovich with Insurance Network America. We've got some great subject matter today. I want to thank you for joining our call on learning how to help relieve your client's policy loan burden, and specifically how a mirrored loan strategy can help come to the rescue. At Insurance Network America, we take great pride in providing you with the knowledge, support, and helpful ideas that you need in your practice. And at the conclusion of today's call, we're very confident that you will have something new to add to your tool belt of client solutions. We've got a solid turnout today with many familiar names and many new names as well. I'd like to welcome you all and encourage those that are not yet contracted with INA to give us an opportunity to earn your business. We have a lot to cover. So I will quickly turn the call over to David Neal and Wayne Radke with Prudential. Before I do that, I wanted to point out that we will do our best to answer your questions towards the end of the call. So if you would, please submit your questions through the GoToWebinar menu on the right of your screen, and we will address your questions towards the end of the call. If you have questions regarding today's call or questions about becoming contracted with Insurance Network America or more about what we do and how we can help you, please do not hesitate to call us. Our number is 800-456-7999. So at this point, I would like to introduce our wholesaling partners from Prudential, Mr. David Neal and Mr. Wayne Radke. Thank you, gentlemen, for joining us.
Thanks, Tom.
Yeah, thank you, Tom. Thank you, and thanks for that introduction, and thank all of you for being on the phone and on the webinar today. I know we're all very busy, especially this time of the year, and we really believe that this is going to be a good use of your time in terms of introducing a couple of strategies that can help your clients and help you help your clients and help you grow your life business. So just by way of a little bit more specific introduction, so I'm the regional vice president, better known as the external wholesaler for Prudential, and I cover 5 states in the Southwest of Arizona, New Mexico, Utah, Colorado, and then also Idaho. So I call on a number of agencies throughout my territory, and one of them being in Boise with Insurance Network America, INA. So I can tell you the folks that have not yet done business with INA, you're in great hands there. They're really great agency with a great support staff and really a good partner to us. So looking forward to this as we build a relationship with you. So what we wanted to do today is go over specifically, I think on the invitation you saw that the topic was how to help your clients with their policy loan burden. And we're going to be getting into an idea called mirrored loans or loan rescue. But to set the stage a little bit, first and foremost, when we talk about, let me back up, in my travels, and I was just mentioning this to Tom, one of the most common questions I get at an agency or with a producer, meeting individually with a producer is, hey Dave, where are you seeing the business coming from? Where's the activity? What are other people doing? And over the years, there's always different answers to that. But I would, right now, and Wayne can attest to this, I would say for the last year and a half, and it's a growing situation. Really, it's policy review and specifically loan rescue, and that's what we're going to be looking at. And it's a great idea because it's relatively simple, and you've got a lot of opportunities out there. So that kind of is a good starting point. And if you look, why policy review? The nice thing about policy review is you can do it with your current clients. You can do it with prospects. If you don't write a lot of life insurance, you do annuity business or property and casualty or investments, things like that. These are all still things that you can do with your clients, and we have a really nice policy review kit that we can make available to you through INA that'll help guide you through the process. But we'll go through this deck relatively quickly so we can get to some sample case studies and really show you how this all works. But one of the reasons you would do, as this slide points out, you would want to conduct a policy review is just what's happened with mortality improvements. Obviously, people are living longer, as this chart suggests, and that has an impact on a lot of things, especially the life insurance that they have and have had in force. Remember, in-force policy review begins with just a couple of quick questions. What's their current life insurance situation? What amount of coverage do they have? Do they not have any? And oh, by the way, can we review that coverage for you? And that's where you're going to find the opportunities to help your clients and to also grow your life business. So you can click to the next slide, Wayne. And, just a little bit of an overview, most of this in terms of, kind of product evolution. As a carrier, Prudential, we write a lot of term insurance, very competitive in that marketplace. But sort of the traditional products over time have been term insurance and then whole life. You can go to the next slide. But things have evolved, okay? I mean, we're, as all of you on the call know, there's a lot more product offerings out there than term and whole life. We have universal life from back in the early 80s when that started, and as part of that, all sorts of different types of universal life products, survivorship products. We have VUL, variable universal life, indexed universal life. So there's a lot of product offerings out there that that very likely were not available or not available in their current forms when your clients or prospects initially bought the life insurance that you're reviewing for them. So there's, again, mortality improvements, products have changed over time, and then we know what's happened with with interest rates, and that's right now it's been pretty steady. They've been down, right? They've been low, creeping up a little bit, but that's also had an impact on the type of products that your clients will find attractive. Way back in the 80s, everybody was, we had what we call disintermediation. You had a lot of people taking money out of their whole life products and putting them into universal life that was then crediting 11, 12, 13%. Well, that didn't last all that long, and then variable became very attractive and really still is. Indexed UL is not on here, but that is as well. And many of you know us for our strength in the guaranteed UL marketplace, which is also a changing marketplace. So with this, the impact of interest rates on product and product designs and competitiveness of products, it's really changed the product landscape. You can go ahead and go to the next. So that just kind of sets the stage a little bit. Most of that, I'm sure, was a review for you, but kind of set the stage as to where we're going to go with this. And so when we look at, we're going to look at some case studies, of course, but when we look at who may benefit from this, so it's a lot of these, I laugh sometimes because a lot of these target profiles are very similar, ages 45 to 70, high-income earners. Here's a key: they have to have the coverage in force to do the review. Of course, if they don't have any coverage, there's an obvious situation there where you can help them and get them coverage. So again, the simple process of in-force policy review really will reveal a lot. But for what we're talking about today, you're going to be looking for those individuals that in fact have life insurance in force, and specifically cash value life insurance, whole life insurance, universal life insurance, VUL, really any cash value life insurance that may be loaned and in many cases heavily loaned. So when you look at this, thanks, Wayne, when we go to the next slide and look at what happens when that policy review uncovers a loan, again, you're going to be determining a lot of things in the work that you do in reviewing that existing coverage. And I will add again, we have a really nice kit that we'll make available to you through INA. And be able to get those out to you that have questionnaires and things and steps to kind of walk through this process. But one of the things that policy review will reveal is the possibility of a loan. And a policy loan is in and of itself is really of no issue. It's the policy owner's right to take a loan against their policy, and there's many designs and sales ideas where policy loans are integral to the solution that we're providing. But in many cases, the loan is a problem, mostly because it's a large loan And it's a large loan that is in many cases that we see is creating a problem. It's large enough where it's eating up all the cash value of the policy, and it could result in a situation where the policy is in jeopardy of lapsing. And when we have a situation like that, and you have a loan on a contract, and it's really, when I say large loans, of course, present larger problems, but it's really all relative. Any loan that is creating a situation where the policy may lapse is a problem for your client. Of course, assuming they want to keep their coverage in force, they need the coverage, which is often the case. Perhaps their insurability has deteriorated and they need that coverage, but they don't know what to do because this loan is out there. The big driver to the loan rescue idea, and throughout this and some of the materials that we can send you, you'll see it sometimes referred to as mirrored loans, but I kind of like the phrase loan rescue because it's a little bit more impactful and a little bit more descriptive. But the real driver with a loan rescue program is, or situation, is the potential tax liability that is there, the potential tax bill that is there for the client. So because we know that with a loan on a policy, if it's such that it causes the policy to lapse, or if they surrender the policy for whatever reason, and to the extent that there's gain in that contract, that can create a significant taxable event. They'll get a 1099, they'll get a tax bill if that policy lapses and there was gain in the contract. And we'll get into some scenarios there. So what are the options? Well, obviously at this, one of the options is not really going in order here, but it's my experience. It's kind of what the clients choose to do or want to do first is do nothing. I pointed out before, a loan in and of itself is not necessarily a problem, but if it does have a negative impact and could result in a tax liability, then we want to do something about it. But their first thought would be to do nothing. Let's just hope this goes away. Well, that's not obviously going to be it's really the good solution in most situations. Paying the loan off out of pocket, that's totally fine too. Again, the goal is to get around that potential tax liability and keep their coverage in force. But there's better options in most cases than doing that. Certainly that's better. Paying the loan off out of pocket is better than letting the policy surrender, but that requires the client to have those additional funds available, and it's going to keep them in their same product, which is often an older, sort of out-of-date, if you will, whole life policy with very inefficient pricing and very, very large loan spreads. The next solution, and the one that we're talking about today, is to do an exchange, do a 1035 exchange, which is nothing new. You're all familiar with 1035 exchanges, external changes from an in-force policy with one carrier over, with a cash value life insurance policy over to another carrier via the 1035 rules, which is, of course, a tax-free exchange. And we're going to get into some samples here, but what we do with that, and there's a lot of flexibility, is we can bring the loan over, we can pay some of it off partially, what have you, whatever we need to do. We'll show you some numbers here in a moment, but we're doing that exchange, and often as part of that exchange, we're going to eliminate all or most of the loan. Sometimes in the trickier cases, we'll carry the loan over, but we're going to bring them over into a new life insurance product, very likely a much newer, more efficiently priced product, with much, much lower loan spreads. For example, most of our permanent products that you would be using for this strategy after the 10th year have essentially wash loans, about 5 basis points, 0.05% loan spread. So that's the cost of borrowing, 0.05%, versus the policy that they're in currently, which could be a whole life policy that sometimes can have a 3 or 4% loan spread. So it's very inefficient. It's a very inefficient design. So you can go to the next slide there, Wayne. And then this gets into some of the taxation issues, like we said. They refer to boot here, but that's, in my mind at least, is a little bit of an antiquated phrase. It's just that it's the taxable event that it just relates to some of the private letter rulings that relate and speak to the taxable event. Again, to the extent that there's gain in the contract and you let that policy surrender or lapse, they let the policy lapse, it's going to create a taxable event. You can go to the next. So then we're going to get into a little bit of the mechanics, and then we're going to see some of the actual ledgers on sample cases. They're not actually sample cases; they're cases that a couple of cases that we've actually worked on. A couple of things to point out. We talked a little bit about where to look for these opportunities, some of the demographics, ages 45 to 70, high income earners, in-force life insurance policies. Where we find more specifically, to drill down a little bit more specifically, where we find a lot of these, where we find a lot of these opportunities is with older whole life policies. And the reason for that, there's certainly nothing wrong with whole life, but a lot of those policies have been on APL, automatic premium loan status, for years. And one of the things that I've seen in numerous scenarios is you may be the first person as their advisor, as their producer. You may be the first person that brings this situation to your client or prospect's attention. They may not even know, because of the nature of an automatic premium loan, they may not even know that these loan balances have been accruing. And so often that's one of the things that's really nice. You're going to be, in many cases, more than half the cases, you're going to be the first person to bring this to your client's attention and then offer some solution. So whole life, because of the nature of it, because it's an older product, it's been out there for many years, because of the attractiveness, if you will, of the automatic premium loan status, those are the types of products where we're seeing a lot of the business come from, a lot of the opportunities with the large loans. Well, a couple of things regarding our requirements and a couple of competitive advantages for doing this type of business with Prudential. We are not the only carrier that will allow for loan rescue or mirrored loan programs. There are some carriers that don't or won't. They just don't want to deal with it, and there are some that do. However, some of the things that give Prudential a competitive advantage is many companies are very restrictive as to the size of the loan that is coming over on the in-force policy, and they might set a restriction, a percentage, a very hard, strict percentage restriction on loan to value. Often it's at 60%, right at about 60%, where loan to value, and you can't have a loan that is larger than that. So yeah, they can still do it, but they're more restrictive. Our only kind of requirements, if you will, really the main one is that on the policy that is coming over, the client must have the product must have a minimum net cash surrender value of $25,000. So again, we don't have a percentage restriction or cap of loan to value of, say, 60%, like a lot of carriers do. So we can take on the bigger loans, the trickier cases, but we do require that it have that minimum net cash surrender value of $25,000. And each and every one of these will require corporate underwriting approval. But I can't stress on you enough, that's all done internally. We do, and we'll see here in a second, we do all of the case design for you. I mean, we obviously will work with, you'll work with INA, and we'll partner with them, but we can do all of the, partnered with INA, we can do all of the design. Some of them get tricky. We have one or two people full-time in our advanced marketing department that basically are doing nothing but loan rescue cases. And so kind of be able to walk you through the cases and help you with design and things like that. And so when we talk about things like approval, I don't want you to look at this and say, oh gosh, there's going to be all these hoops we have to go through. No, there's not. You just bring us or bring INA the opportunity, and then we can take it from there. All this other stuff regarding approval and things like that is done behind the scenes, and you don't have to get involved. You can go to the next screen, Lynn. Okay, so this one I'll tell you what, Wayne, do you want to go to the other one first and then come back to this one if that's possible?
Sure.
Yeah, if you got it. So what we're going to do now, and please, like Tom said, submit any questions as we're going through this. I want to keep to our time constraints, so I know we're going at a pretty quick pace here. But what we're going to be doing now is going through two case studies. These are illustrations, and hopefully you all can see that on your screen and maximize it if you need to. But we're going to go through two actual cases. One is what we call a smaller loan scenario, sort of an easier case, if you will, and that's the one Wayne's going to highlight here. And then the second one that I'll be talking about is a larger loan. The overall policy is smaller, but a larger loan, a trickier case, because I want to be able to tell you and show you, we want to be able to show you and illustrate that we can work on the harder cases, the more difficult cases, the more challenging cases. Wayne's going to go over this one, and it's great. Many of them are this simple. Many of them are slam dunks, and it's almost a no-brainer scenario. But some of them do get tricky. So with that, I'm going to just hand it over to Wayne now to go over this. Before I do that, real quick, Tom, anything that you would want, Tom or any others at INA, anything that you'd want to interject at this point?
No, go ahead.
Okay, great. Okay, Wayne.
All right, so in this example, we've got a 50-year-old who got qualified for non-smoker plus category. He had $3.5 million of coverage in force. He had a $1.125 million of cash value, $525,000 of cost basis, but he had a $240,000 loan on that policy. He was still paying premiums on that. We were able to bring that $1.125 over, getting him $4.5 million, so another additional $1 million of coverage, plus pay that loan off in year 2 with internal values. Because his cost basis was higher than the loan amount, we can use internal values to pay that loan off and continue that policy with no additional premium payments for the rest of his life, using our Founders Plus product. So it was a great design for him. The client was very happy. No more premiums for him. He got that loan he actually was paying 8% loan interest on. He was excited to be able to get that gone, and it was a win-win for everyone. And some of our competitors do have limits on how much we can bring over. We do not. So some carriers might say they have $1 million 1035 limit. We don't have any caps on the amount of the cash value coming over, and we do pay on that full 1.125, not the difference between the cash value and the loan. So you get paid your first year plus the excess on that as well.
That's a great point, and thanks, Wayne, for all that. But that commission issue, just to reiterate, that's another one of the competitive advantages. And in addition to being able to handle the larger loans with no percentage restriction on the size of the loan, the way we pay, like, just to reiterate what Wayne just said, the way we pay commissions is unique because, like Wayne said, we'll pay the full, first year. It's a new policy, right? So you'll get first year commission on the target premium and any renewals, etc. But there's also an excess commission rate, 1 or 2%, varies by product, that we pay, and often these cases, as the one that Wayne just highlighted, there's 7-figure amounts involved, and we'll pay the excess commission rate on the full amount coming over, including the loan. So if you had a $750,000 cash value and a $500,000 loan, most carriers would pay excess commissions on that $250,000. The difference, we'll pay it on the entire amount coming over. So obviously, first and foremost, you're providing an incredible, effective, relatively simple solution for your client, but you're well compensated for it. The other thing that so Wayne, were you going to say anything more about this particular one?
No, and this also allowed him, now that he used the internal values, he still does have $275,000 of cost basis that he could do a withdrawal from without having to loan it to get at his money that he's got in that contract. So it gives them some more flexibility, and we can also add the riders to these policies, the chronic illness, things like that, to those riders as well.
Yeah, perfect. Yep, like our benefit access rider. Some of you, Wayne just referred to our chronic illness rider, which is a benefit access rider, or BAR for short, and that's our extremely competitive chronic illness rider. Again, just one of the many things that you can do, getting them into, again, first and foremost, avoiding the potential tax liability, being able to let them keep their coverage, getting them into a more efficient product, and being able to add riders that just simply weren't available on the policy that you're assisting them with. So the second second and final, I guess, I would say, in terms of the case studies we're going to go over today, is another one that Wayne just put up. And again, hopefully you can see the numbers. If not, try to maximize it. But this one was a trickier case. And again, we have people, and we partner with INA on this as well, where we'll do all the design work for you. Just, you're doing the key step, and that's bringing us the opportunity, the problem, if you will, and we'll help you with the solution. We'll run all these for you. I've worked with many producers where they just bring us the opportunity, or the agency the opportunity, and that's it. I mean, that's we do all the work from there. So this one that you see on your screen now is a little bit of a trickier case. It's a male age 54, and both of these examples we used, as Wayne pointed out, our Founders Plus UL product. You can use them. You can use any one of our permanent cash value life insurance products. This one tends to work the best and is a very popular product, but you could use a traditional GUL. You could use our IUL, a current assumption UL. So there's a lot of flexibility there, but we're looking at our Founders Plus product. This one was trickier. Now, this one we call our large loan example, which might seem strange because this is a much smaller case, smaller death benefit, things like that, as you can see. But the loan itself was much larger as a percentage of the total cash value. Some of the stuff that you can't see without knowing about this case is this was a situation where the client had a $260,000 loan, and there was a $60,000 basis, okay, cost basis. And those are some of the things that we'll need to get from you, ourselves and INA will need to get from you to do these, but it's relatively simple. But so the size of the loan in this one was $260,000, so a large loan compared to the amount of cash value. $60,000 was the basis, right? So what does that mean? There was a $240,000 gain, on this contract. So if in this particular client's circumstances, the top income, federal income tax bracket, so if he were to do nothing, just let it lapse, he would have been hit with a $96,000 tax bill, a $96,000 1099. And oh, by the way, he loses his coverage. In this case, he really needed to keep his coverage because of insurability issues, and it had deteriorated a little bit, but we were able to make it work. So again, the do nothing approach here would have been a nearly $100,000 tax liability, tax bill to the client. So what we did, as you can see, and again, this was trickier. The first thing the client wanted to do is do nothing. Well, when we pointed out, well, here's the cost of doing nothing, which is that $96,000 1099. So we kind of got him to think that you have to do, in this circumstance, you're going to have to do something. Unlike the other more simple example that Wayne just showed you, where it was really a slam dunk and the client didn't have to pay anything out of pocket, our advanced marketing people came up with a solution here where the client did, as you can see, did in fact have to pay something out of pocket to make this work, the $10,400 for 5 years in a row from years 2 through 7, and then took withdrawals to, in this case, we didn't entirely pay off the loan, but to pay off part of the loan and to make this work. And so what it came down to, we were able to make it work. We were able to do this exchange. Yes, the client had to pay something out of pocket, but it was $52,000 out of pocket versus a $96,000 tax bill. So, I always like to show this one or talk about cases like this because they're not always going to be easy and they're not always going to be slam dunks. But we have the ability at Prudential to take on these tougher cases and have the expertise to be able to come up with solutions. And this was a scenario where we were able to do that. We'll always tell you up front, our case design folks will tell you cases that just simply aren't going to work because they don't all work. But many of them do, including the tricky ones like this. So that's kind of why I like to always bring up the sort of the more complicated ones so you can see what we've achieved with this. So Wayne, you can go on to the, let's see, I don't know if you want to go back to the deck. Not sure how much more we had on there. Yeah, so that we were just on
David and Wayne, there was a question on the previous illustration that came up, if we could address it real quick.
Yeah, let's go back to that, yeah.
It shows...
So when you say previous, you mean previous to the first one, Tom? Or?
I believe so. Let me see here. Yep,
okay.
That's the one. And so the question was, you paid off the $249,000 loan, yet the CSV went down only by $30,000 or so. Could you explain that?
Yeah, let me look at that, Wayne, because that was because it was a withdrawal.
The loan surrender value was included there, and we just took the cash value and took that loan and paid it off. So it went down in one column and up in another. So it's just an offset, and that's just the normal surrender charge and the growth of the policy that's occurring at that point.
Okay, thank you very much.
Great. Yeah, thanks. I'm sorry, Tom, you said there was another question at this point?
No, go ahead. Thank you very much.
Yeah, we're getting towards the end here, and then we can open up to whatever other questions there may be. And then some of this, again, we've already mentioned, sort of what are the benefits? I mean, of course, first and foremost, what we're trying to do is we're trying to help your clients. And here's an idea where you're able to do that. Just to reiterate and to summarize, let's not forget, one of the things we're doing here is we're helping your clients keep their coverage in force, and that's a big thing. Of course, the driver really tends to be avoiding the tax bill, but again, not only are we offering a solution to that potential tax liability, we're allowing them to keep their coverage. Get into, like we said, get into a more efficient product, and then as part of this sort of the policy review scenario or procedure process, if you will, and specifically loan rescue, you're really going to be deepening that client relationship with your client because you've really solved a really significant issue for them. And remember, I would say roughly half of the situations that we've seen, and Wayne can attest to this, it's you, the producer, the advisor, the planner, that is the first person bringing this situation to your client's attention. So in many situations, you come out looking like a hero, as you should. Wayne, is there a next slide? No, probably not. Oh, so some of the conversation starters, and again, we'll send you our complete policy review kit, which will have some of these things in here. But we talked about a lot of this. When was the last time you reviewed your life insurance policies? You're going to ask basic questions to start. What's your current life insurance situation? How much coverage do you have? What type of coverage do you have? It's often, sometimes they'll have none, sometimes they'll have some, sometimes they'll be insufficient, and then sometimes you'll get into other things regarding beneficiaries and things like that. But this is where just simple questions where you're going to be able to uncover these opportunities specific to loan rescue. All you really need to get from them is, ideally an in-force policy illustration, an in-force ledger, maybe, also just maybe their most recent quarterly statement, anything that's going to show you some of those values. And then as we drill down and we identify that potential issue with a large loan balance, and that's when we'll get in and help you, finding out the basis and things like that, so we can determine the best way to go. So basically, these conversation starters are pretty self-explanatory. Here are some of the, and Wayne, I'll let you go through this if you want to. Some of the I think Wayne's going to show some of the materials we have available we can make available to you and also available on our website.
Right, so here's a piece that is approved for use with clients. So a lot of times clients are a little leery or skeptical when you talk to them about this approach and is this really a true strategy. So we have created a piece that does talk about the mirrored loan and the options that they had that we went through on that. So it actually helps you walk through the process with them. What are their options? What could they do? So it's a really nice piece that talks through all of the moving parts to this strategy, how they can exchange this policy. It's a very good, well put together piece so that they feel comfortable about how they can move forward with this new policy and take care of a concern that they have on their current policy and give them a policy that might more fit their needs going forward. We have that piece, and then we also have a strategy piece, which is more just for you to, recall when you're, before you're going out, what are the talking points to talk to clients about. Gives you some examples there so you can be familiar with that, how the policy exchange would work, what we need to do to have that come over, and what are the requirements as well. So it kind of summarizes what we went through on our PowerPoint in a quick 2-pager, so before you go out on that client appointment, you do have something to reference.
Yeah, that piece is that's relatively new, and of course compliant for use with clients, and so it's nice, like Wayne pointed out, to have as part of that conversation starter, to have some numbers, some sample numbers to show your client or your prospect the impact of what we're trying to do here and how we're trying to help them. So yeah, in terms of next steps, again, well, I guess that was just more of the kit. So again, we can make that kit available to you. Some of you may already have access to our producer website, Pru Express. If you do, then you can get the information there. But more than likely, the best thing to do is we'll make those kits available through INA. And again, they're a fantastic agency that is very well staffed and well resourced, if you will, to help you on these kind of cases, and have people that can, working with us, can help you take these situations and design them properly and really make it a win-win for everybody involved. So I don't know. Yeah, there's not a whole lot more. I don't think we have anything more, Tom, in terms of the deck here to go over. We went over the 2 sample case studies and things like that. So Wayne, unless I'm missing something, you may Tom, we could hand it back over to you and see if there's any questions.
I just pulled up also, we got a resource guide for you for when you're doing a 1035 exchange. It lists all the carriers, so we'll have that supplied, and Tom will get that out to you so that you have that at your convenience when you're working with a certain company. Some of them will require their own paperwork, and we've got that all indicated on here, and it gives you a time to process some of the time frames that are necessary for each of these companies, so you can set the expectations for your clients on how long this process might take.
And the good thing, that's a good piece. And the other thing too, our level of expertise is very high. And when I say our, I mean I'm talking about the home office and also INA. The home office, our home office, we do a lot of these, so it's not going to be a situation where they're trying, the underwriter or some policy, your case manager or what have you, is going to be asking what's going on. I mean, this is a very well-defined strategy with a high volume of cases. So we know how to get these through and get them through as efficiently as possible. But with that, I think I'll hand it back over to Tom. I appreciate everybody's time today. This is again an idea that I think is sort of immediately actionable, because whether it's a client or a prospect, almost over half of them are going to have in-force life insurance policy, and a certain percentage of those are going to have a policy loan burden problem. And here's a solution where what we showed you today was a very effective solution to not only avoid that tax liability, as I've been saying, but also keep their coverage in force and get them into a much more efficient policy. So you're helping them first and foremost, which is always, of course, what we want to do and what you folks want to do. But it's also a really nice way to grow your life business and your life revenue. So I guess Tom, I'll kick it back over to you.
All right. Well, thank you, David. Thank you, Wayne. We have one more question here that I'll put out to you. Is the question was, do these policies, and I assume the new Prudential policies that you were showing before in the 2 case studies, do they include living benefits for critical, chronic, and terminal illness?
Yeah, so that's a great question. So that was what we were referring to as our benefit access rider, which is our chronic illness rider, which is we could even do a follow-up session on that at some point if you want to, because that's a whole different topic. That is our chronic illness rider. That it's not a long-term care rider, but it functions a lot like one. Benefit access rider is a chronic illness rider. It's an acceleration of death benefit. Lots of flexibility. They become benefit eligible by the same way you would in traditional long-term care, which is not being able to perform 2 out of the 6 ADLs, activities of daily living, or 1 cognitive issue. But then what happens is, what's nice about our policy is it's very flexible. We pay out immediately with no wait, currently without any waiting period, and the money can be used in any way that you'd like. So very flexible and added benefit. We always say with our benefit access rider, again, our chronic illness rider, we pay for the condition, not the care. We pay for the condition, not the care. So there's a lot of flexibility as opposed to some of the hybrid products out there, perhaps like a Lincoln MoneyGuard or traditional long-term care. So that's one of the things that we add that is a very good, effective, flexible option. It's indemnity. It's not reimbursement. So it's very attractive, and so that's a separate rider, but it can be added as a rider to most of our permanent products. Wayne, was there anything you wanted to add to that?
Yeah, and we can go up to Table D on that as well. A lot of the times that people aren't eligible, or they get declined for long-term care insurance, and they're able to get the rider on a life insurance contract that is on mortality, not morbidity. So having someone that was declined for that is not a knockout for us.
Yeah. And imagine, just to expand on that a little bit more, I mean, imagine that, right? In addition to what you're doing in terms of avoiding a tax liability for your client, keeping their coverage, getting them into a more efficient base product, holy cow, you can now also offer them a rider like our benefit access rider that gives them all those living benefits. So it really becomes a rescue of a grander proportion, if you will, because you're able to turbocharge their life insurance to such a degree where they're in a much better situation than where they currently are.
Excellent. All right. Well, thank you both. A couple quick comments to everyone on the call. Our sales team will be following up with you to get you these pieces, the policy review folder, and all these tools for that you can put in front of your clients as well. So expect to hear from us, and we will put those in your hands. As you make a list of your clients and prospects to call or reach out to for a annual review, policy review, and talk about these items. If you have cases in mind, don't wait. Give us a call, and we'll be happy to help you. Our number again is 800-456-7999. And I want to thank everyone for taking time out of your busy days. Good 45 minutes away from your practice, and hope that this was yet another tool for your tool belt as you find solutions for your clients. And we look forward to connecting with you. So again, Wayne Radke and David Neal, thank you so much for your time. And thank you everyone for joining us, and we look forward to connecting with you.
Great. Thanks, Tom. Thanks, everyone. Look forward to working with you.
Thank you. Have a great day. Bye-bye.